Welcome to the program. My name is Marty Shenkman, and we're going to talk about what's going on in the current tax environment in terms of estate tax. We're going to talk about the potential for repeal, the potential for the 2017 Tax Act, reductions being extended for 10 years, perhaps permanently, perhaps not at all. Lot of options. Joining me today Joining me today is Jonathan Blattmachr and Robert Keebler and Teresa Bush from ILS. Teresa, you want to make a quick plug or just tell everyone who ILS is?
I might as well, yes. Interactive Legal is a document assembly, document generation system, and one of our co-founders and editor-in-chief, of course, is Jonathan Blattmachr. And part of the reason that I'm on this presentation today is that we're going to talk about some things that are in our documents that are designed to address the estate tax repeal and these other uncertainties. And so I look forward to talking about those with you all. I will say that when I first started practicing, the estate tax didn't change that much. The exemption was $600,000, and it really didn't change for a number of years. And the partner I worked for used to say that being a tax lawyer was like being a surgeon, but every few years they moved all the internal organs around. And I never understood what he meant, but now I get it because things have now been changing like they didn't change as often in the 90s.
And for those of you who don't use ILS, I personally use it, but that's not why we're doing this. Teresa's not going to just show you things from the program. It's generic in the sense that she's going to give you some sample provisions and concepts that whatever you do, whether you use your own forms, brand X instead of ILS, I won't name the brand, this will all be helpful. And I think it gives more specificity to some of the statements that we are going to discuss. Let's start, Bob. Maybe you can make a comment or two, and I know Jonathan has a lot of thoughts. What's going on? Where are we? What do we tell people? Apart from the slides, let's just talk generally for a couple minutes to introduce the topic, the incredible uncertainty and all the options available. And we're going to give you specifics about what you can do depending on the different outcomes and even things that we think are necessary to change the conversations. Bob, why don't you kick it off?
Marty, we've done a lot of work for AICPA and for Lineberg, and all I can say is we have to focus on 3 possible outcomes. Now, there's variety beyond that, but there's an outcome of sunset, there's an outcome of extension, and there's an outcome of repeal. So we could sunset, everything, that'd be one option. Everything could stay the same, or we could repeal. Surprisingly, the option that actually needs the most love and attention is repeal. And that might shock you, but if we get repeal, it's only going to be momentary, a heartbeat in time. And 4 years, 8 years, maybe 12, and then the pendulum will swing back. And what we do in that interim for high net worth families is going to be just so important to the long-term wealth preservation. And I think we'll talk about some of that today.
Jonathan, I know you have comments, but let me just emphasize a really important point that Bob said. There are lots of variations under each of those scenarios, but clients, I believe, if they even hear repeal being talked about, I don't need to deal with any of this. They're going to repeal it. They may repeal it. I'll wait. That could be a really bad move, and we're going to explain why and make some suggestions. Jonathan, do you have any thoughts on any of this?
Well, Marty, you know I do. And as Teresa said, the law changes so quickly now. Remember, my big claim to fame was I was the author of the book Carryover Basis under the Tax Reform Act of 1976. And there's a long history of my involvement with that, but it really, really was important. We thought it was going to be there. We thought it was going to be there permanently. It passed on October 4, 1976, but it was retroactively repealed in 1980. Now, one possibility, of course, is that we do what Canada did, which in 1973, they repealed their estate tax, which was very similar to ours. 50% marital deduction, about a $60,000 exemption, and so on. But they repealed it, but they put in a capital gains at death. The United States since 1919 has said there is no gain recognition at death. And that seems to really have carried through. And one of the proposals, of course, which we can get into, is repeal the estate tax, but continue to allow the tax-free step-up in basis. And if that happens, there will be extraordinary changes in the transfer of wealth. And as Bob said, it may be only temporary. I want to say one other thing. Back when Bill Clinton was the president, there were proposals coming out of his administration that they were going to go back and basically bring into the taxable estate almost any transfer you made during lifetime, even things like a charitable lead trust or a charitable remainder trust. And as a consequence, all the planning that you had done basically was for naught. And there was at least a couple of essays saying that constitutionally they could do that. And indeed, the Supreme Court has stated that the Congress can retroactively enact an estate tax rule causing inclusion and causing taxation, even if it had never been proposed before, if it's merely a way to raise revenue. So as a consequence, you can't be sure of anything. And what we're going to try to do today is talk a little bit about what do you do in this time of significant political uncertainty. Marty, back to you.
So we're going to go through the agenda that Teresa laid out and talk briefly about the extension of the bonus exemption, the possible permanency of the bonus exemption, which I don't know how they're going to do that, but maybe they will. And then after we discuss some planning for that, we're going to talk about potential for repeal. And I think in the light of the current environment, most practitioners most clients have heard over and over for years, use your exemption, it's going to decrease. Well, now what? What do we tell them? What do we do? So let's talk about the bonus exemption. Bob or Teresa, do you want to just give us a summary of where we are?
Yeah, I'm okay doing that. Sure.
Sure, go for it.
Sure. Yeah. So what has happened just recently is that the House of Representatives has passed a budget resolution and it's going to be considered by the Senate. They have their own resolution, but the key is in the House, the Tax Cuts and Jobs Act, the Trump tax cuts from 2017 that are set to expire at the end of this year would be extended for, again, another 10 years. At least that's the way it appears. And we know that President Trump is in favor of that approach, and so that may be what happens. They have to reconcile these two resolutions, but if they go with the House approach, we are going to not have a sunset. And so, as I said, we have to think in terms of we have a sunset. It's right now that's what's going to happen, but we could get an extension, and so that's where we are as far as what's happening in Congress.
Now, let
Bob,
me add here. The reason that we talk about 10 years is there's something in the Senate called the Byrd Rule. This was for Senator Byrd from West Virginia, who got a resolution passed in the Senate, which to this day has not been changed, which says if the Congress passes a law which either increases expenses or decreases receipts, it can only stay in effect for 10 years as part of a budget resolution, only for 10 years, unless 60% of the senators vote in favor of making it for a longer period of time. That's why the George W. Bush tax cuts, which occurred basically in 2001, were set to expire at the end of 2010. And you may recall that George W. Bush said his major campaign was that the repeal of the estate tax was his #1 domestic agenda. Now, if it was his #1 domestic agenda, why didn't it happen during his regime? Yes, we did get the repeal, but it was only for the year 2010. And what we saw in 2010 perhaps gives us a little bit of an indication what we ought to be thinking about doing now. Sorry to interrupt you, Teresa.
Oh, no, I was actually thinking the same thing, that we have a little bit of a guideline because it's happened before. Some of the people on the call may not have been practicing back in 2010 when we had 1 year of no federal estate tax. So we can perhaps learn from that. We can move on to the next slide.
Bob, you had some thoughts that we had talked about or heard some time frame when we may actually see legislation. Do you remember any of those dates, maybe just to share? Or if not, does anyone else? I think they were talking May, we may have something.
Perhaps before that, but they're waiting for 2 Republican congressmen to be seated in the House, and that won't happen to early April. So there's no way Speaker Johnson will bring a bill before then. Also, keep in mind, we also have this potential government shutdown, and that's going to hold things up for the first half of March, at least. So, you know, I'd be very surprised if we saw actual text until March, after March 15th or 16th. Actually shocked if we saw text, because it's not in Speaker Johnson's best interest to show his cards until we get closer.
Anyone else have any thoughts on when any of this may happen?
Well, Marty, you know, going back the past few years to when things happen, I mean, if you go back to even the Tax Reform Act of 1976, that wasn't enacted into law until October 4 of 1976. And then when Donald Trump became the president and he made certain proposals, those in his first year was 2017, those weren't into effect until that year, because they couldn't get it signed by him until the middle of December. And, you know, that could happen again. To think that something will happen, maybe it could in something like April, I doubt very much it would happen. The budget, which they had, would go through a budget reconciliation to try to get these changes. It's very, very complicated, with each senator and each congressperson trying to decide what's in his or her own best interest. And there will be a lot of give and take. But I don't think they can do much, extend these things for more than another 10 years at most. But they'll have to give up something else. Again, remember, George W. Bush said, my #1 domestic agenda is repeal of the estate tax. The reason it didn't happen, even though he had, just like Donald Trump has right now, had the White House and the Senate and the House of Representatives, it was going to cost something. All these things need to be scored. And you've got to score them, and that means you can't do everything you want. Now, maybe the repeal of the estate tax is something they really want. Getting rid of the tax-free step-up in basis would tend to offset that. But again, they said, no, we're going to retain it. And let me tell you that if that happens, you have a repeal of the estate tax, and you yet allow the tax-free step-up in basis, there will be some new planning that you'll do. Just let me mention one thing. One of the proposals is that they're going to retain the gift tax, although it may be reduced from 40% to 20%. That's one of the proposals. But they've gone ahead and they've said, well, okay, we're going to do that. We're going to have a gift tax, but no estate tax. But you can put property into a trust that would be out of your estate as long as you make it a grantor trust for income tax purposes. And there was something that came out of the 2000 Tax Act, 2001 Tax Act, which indicated that. It was kind of changed, but basically you can create an irrevocable trust that would be out of your estate. And yet if you make it a grantor trust, it's not a completed gift, so you don't have to pay gift tax. Yet it's not going to be subject to estate tax when you die because there's no estate tax. And yet you get the tax-free step-up in basis by having it basically in your estate. So you want to structure it so it's in your estate, and yet you don't pay any gift tax on it because it's not a completed gift, because it's in a grantor trust. It will be in your estate. You get a tax-free step-up in basis. And how people will then jiggle things around to basically keep an interest in it for themselves. For example, you do a trust that's irrevocable. You retain the right to the income. That's includable in your estate. It's like having a grantor trust, but it's going to be includable in your income and going to be includable in your estate. So you get the tax-free step-up in basis. So you basically get the step-up in basis, no estate tax, and yet you've made it an incomplete gift because if it's a grantor trust, it's deemed to be an incomplete gift. So that's right now what I think people will do. Yeah, I'll create these trusts. They're going to be in my estate, which I want, so I get the tax-free step-up in basis, but there's no estate tax because they've repealed the estate tax. So that's what I think people will begin focusing on. Now, how long that will last, who knows? But that would be an extraordinary change in our tax system. And I'm not sure it's ever going to happen, but that's some of the proposals that will be made.
We're going to talk about that further, Jonathan, when we get to the repeal, because there's a lot of other aspects of it. But let's start first, because you made a comment that I think is really important and kind of the theme of the next section, which is, what if we don't see legislation till October or even worse, December? Depending what that legislation is, what if, because there's actually a few more things on the agenda than just repealing an estate tax. There's a lot going on right now. So we don't know what's going to happen. And if you wait to December, there's not going to be time to do anything. So that's part of the themes of what we're going to talk about now. So we don't know what's going to happen. Nobody knows what's going to happen. For years, we've all been talking about use it or lose it in terms of the exemption. But what do you tell clients now? So one thing they could do, based on all the different things that were discussed, is, and this is the thing I think in fear most clients are going to want to do, is wait and see. But as we said on the slide, you wait and see, time could run out. If you wait and see and they don't get this passed because other priorities, whether it's, budget, immigration, whatever, there's a myriad of different things going on right now. If other priorities take over and they can't get the bonus exemption extended, if you don't find out till October or December, it's going to be too late. Another approach is to use the bonus exemption anyway, and we're going to talk about that. And a third approach, and this is sort of a broad category, and we'll talk about some of the details, is use the bonus exemption, but build in flexibility. Do either of you want to talk about wait and see, Teresa?
Sure, because I put this together, and really what my version of wait and see ends up being is really go ahead and do the planning, but add flexibility, as you'll see. Because as Marty said, the clients are going to think, let's do this. We're going to have an extra 10 years. We can, kick the can down the road, so to speak. But time could run out. It could happen late in the year, and nobody wants to be scrambling like a lot of people were scrambling in 2012 to try to get planning done before the end of the year. And there will be a lot of clients who now finally say, oh, I really need to do this, when they realize the clock has run out, if it does indeed run out. So some ideas that we'll talk about, it really comes to this standby trust idea that comes up on the next couple of slides. But if we can encourage clients to start the process, to at least get some things in place, create the trust documents and have them in escrow, sitting there waiting. Maybe fund the trusts, but they're revocable, and all we have to do is make them irrevocable to make things happen. So, and then there's a lot more ideas coming up on upcoming slides about the standby trust. But I think that we've established wait and see is not what we should recommend that clients do, even though that's what they're going to want to do. And so the other ideas are, oh, sorry, go ahead.
I'm going to blame Teresa for the wait and see moniker. My thought is, you snooze, you lose.
I like that better.
And I think we both agree. And that's a problem. And finish your other thought, and then I want to ask Jonathan a question.
Oh, I was going to move on to the idea that we should just tell clients to do the planning now, because it makes so much sense, even without the flexibility, which is on the next slide. But let's stay here and talk about wait and see until we've exhausted it.
So no, I think there's just one point to make, and Jonathan, you can make it quickly because I know you're passionate about it, but I feel the same way you do, and I suspect that everybody here does. Even if the estate tax is gone, and we're not sure what's going to happen and how to jigger it because of maybe you get a basis step up even without an estate tax, leaving that aside, apart from taxes, estate taxes, transfer taxes, if you had your druthers, wouldn't every dollar possible be in a revocable long-term trust?
Well, Marty, there's no question that, I'm the most pro-trust lawyer in the world. Everything should go into trust, even if you think, well, my kids are going to need it. You can always take it out. As many have heard me use the analogy, it's easy to get toothpaste out of a tube, but it's very tough to get it back into a tube once it's out. So you want to start by having it in that tube. You want it in trust. And if you don't want it in trust, you can always make a distribution. So that's one of the things you've really got to consider and really think about doing a trust now, a revocable trust, or maybe better yet, an irrevocable trust, even if you want to make it an incomplete gift, because it's relatively easy to make a trust, even though it's irrevocable, incomplete. And of course, it will then in almost all cases be includable in the grantor's gross estate. But you could have everything set up. It could be incomplete, and you just have to flip the switch and it will be complete. And I think that it would be a mistake for people not to get that done. Understanding you can change it, lots of ways to change it, retaining the power to change, or doing something like a so-called decanting, where you pay the assets in that trust to one or more other trusts which have terms which appear to be better.
But for asset protection, divorce protection, all the things that concern or should concern every client, planning shouldn't wait. And if we can build in flexibility because of the uncertainty with respect to the transfer tax system, planning shouldn't wait. And I think part of the messaging problem is that clients, whether from estate planners, financial advisors, or what they read on the internet, have been just pounced upon with the same theme. Use your exemption, it's going down. A lot of clients have estates much smaller than the exemption, and it's not even relevant to them. But even for clients with large enough estates, if the estate tax is repealed, maybe that's irrelevant, but asset protection remains the issue. And there's no reason not to protect assets from divorce and other potential claims. So I think we all agree, and I think anyone on the call probably agrees that planning makes sense to continue regardless. For ultra wealthy clients, I think, I forgot if it was, I think Jonathan or Bob, one of you said how if it's not in 4 years, it's in 8 years. If it's not in 8 years, it's in 12 years. Pendulum's going to swing back. We can't predict what on earth is going to happen when the pendulum swings the other way, but it seems like politically it always has. So why on earth not get everything in trust, long-term, robust, very flexible trust now, on the hopes that you'll be in a better position to do something, whether it's act quickly or just maybe it'll even be grandfathered and out of the estate when the laws change yet again the other way. Jonathan, Bob, anyone? Teresa, comments?
No doubt it will swing back, Marty. So we may have a window, and it's what do we do during that window? And when we get to the GST stuff, we'll also talk about during that window, how do we take distributions out of trusts that are grandfathered or exempt? I mean, there'll be some very interesting chess being played during that period of time.
So some of the flexibility that can be infused in planning now, you could do a standby plan to avoid the year-end rush, and certainly 2012 was impossible with that, and lots of people didn't get planning done or had to go to general practice attorneys because estate planners were just too busy by year-end. Set up the trust, set up the plan now, and just have it in the on-deck circle. Q-tipable trust, you can make a gift to a trust that qualifies for a Q-tip, and you have until the gift tax return next year to make a Q-tip election, and if you do, then you haven't used the exemption, and if you don't, then you have. You can use disclaimer provisions to unwind a trust. Rescission, you can use lifetime powers of appointment and decanting provisions to further build flexibility in. So all these different techniques, or any combination of them, is a way to get planning done methodically, thoughtfully, but be prepared for what might come. So in terms of the standby trust, you can make a transfer, you can give, and you can even do an inexpensive local trust as opposed to, for example, if you're in New York or California, going to a better jurisdiction that's more trust friendly like Nevada, Alaska, South Dakota, Delaware, etc. You could even use a family trustee instead of an institution. We've talked in other programs about the benefits of using professional or institutional trustees, but you can start with a simple trust if the client doesn't want to incur the cost or complexity of a more robust trust, and just give the flexibility in that trust to move it to a better jurisdiction, or as was explained earlier, if it's, you retained a limited power so that it's in your estate, and it's an incomplete gift, that can always be relinquished. And you can use and prepare now transfer documents, so you can make a transfer if you have to quickly before the end of the year, even if it's not going to have an appraisal completed, because maybe the client doesn't want to incur the cost now of the appraisal. So I guess the gist of this is that you want to get the documentation and the planning set up, so just in case they don't extend the exemption, it can be used for those clients that have done it. And one of the things that may be helpful on slide 12 is a two-tier adjustment mechanism. So if the client's not going to incur the appraisal fee now for a family business or real estate LLC or other property or asset, they can make a transfer to the trust. The first adjustment will be to adjust the percentage interest based on the appraisal that will be obtained. And the second adjustment would be your more typical Wandry type adjustment for gift tax values finally determined. But that may be a way to enable a client who doesn't want to spend the money today on an appraisal to still get everything in the on deck circle, and even make a transfer if there's a crush at the year end and they can't get an appraisal.
Marty, would you explain a little bit more about the first way to do this?
When are you
You
talking
said
about the
there were two ways you could adjust this. What would be the first one?
I proposed a two-tier adjustment. Normally, you would have a client get an appraisal of, let's say, a family business interest, and you would make, if you wanted to use a Wandry type valuation adjustment mechanism, let's just call it 14 million instead of 13,990. 14 million to this trust. Based on the appraisal, it's estimated that that's 50% of the interest in the family LLC. The problem is that's your traditional Wandry. The problem is right now, I think a lot of clients are going to be hesitant to go out and spend the money because it's not inexpensive to value interest in a closely held business. They may be willing and say, okay, I'm willing to tee up the planning in case something doesn't get done to extend the bonus exemption, but I don't want to spend all the money on an appraisal today if I don't need it. So now if you get into a time crunch, and let's say it's passed in November after Thanksgiving, you don't have time to get an appraisal complete because it's going to be as bad or worse than 2012. So what you could do is you could give 14 million worth of that LLC to the trust and add an additional adjustment mechanism to your traditional Wandry. Now, there's no authority on it. This is just a thought that I'm suggesting to try to practically deal with it. I hereby transfer $14 million worth of LLC interests. The percentage will be determined based on an appraisal from an independent appraiser, and they could even hire the appraiser at that point in time, but you'll never get anything done, and reference that. So if you get an appraised value in February, you're going to estimate what that 14 million is in terms of LLC percentages. That's the first tier of adjustment. The second tier is your traditional Wandry, that if there's a gift tax value is finally determined, we'll adjust it based on that. Was that what you were asking?
Yeah, I wanted to hear, but so you're saying that your first one, you're going to adjust based upon the appraisal.
The independent appraisal.
Which of course will not be binding upon the Internal Revenue Service. So you come in and the appraiser says, well, this is worth $28 million, or and you say, okay, that means half of it goes based upon the appraisal. Now, what happens, Marty, later if the IRS comes in and says it wasn't worth 28 million, it was worth 64 million?
You adjust again.
And that's based upon the tax value.
It's adjusted the second time as your standard Wandry. The point is that if you can't, the normal way to do a Wandry clause is you have an appraisal and you're basing the dollar value and estimating, as an administrative convenience, the percentage membership interest based on an appraisal. But I don't think a lot of clients that are thinking about extension of or permanent extension, especially the 2017 tax reduction changes is going to happen, and certainly not if they think repeal is going to happen, they're not going to be willing to incur the incremental cost of an appraisal. So what else can you do if you find yourself in December? Let's say the client created the trust, but and you drafted an assignment. What do you fill in the blanks? You have no appraisal. What are you going to do?
Well, Marty, when I've had laundry clauses and I've used them extensively, and I used them probably 20 years even before the laundry case came down, it was based on I'm giving that fractional share of this interest in the LLC or the business or the whatever it happens to be, which as of this date has a value as finally determined for federal estate tax purposes equal to 5 million, my remaining exemption, whatever you're going to use. So you'll, of course, will make an estimate, but if the IRS comes in and says, no, Jonathan, you thought this was worth 28 million, so you think half is going, $14 million worth is going into this trust. But if the finally determined for federal tax purposes happens to be 64, then you're not going to be doing that much,
Correct.
and nowhere near as much, but it will all be dependent upon the finally determined for federal
Yes.
tax purposes.
I'm not suggesting a change to the application of the traditional laundry approach, or if you do a Petter or Christensen approach. All I'm suggesting is a practical way to deal with what might be the reality of, oh my, we just found out in November that the laws changed and we're not changed, and we're not going to have an extension of the bonus exemption. How do you make a transfer? I think what I've given you is the only practical way to do it, because you're not going to be able to get an appraisal in time. You're not even going to get a number. In 2012, at some point, maybe November, maybe even October, appraisers said, we can't give you the report, but we'll get you a number. At some point later, they said, we can't talk to you, we're too busy. So what do? I've tried to give you a solution. Let's not belabor it too much. It's just food for thought that I think may help, because I don't think a lot of clients are going to want to spend the time and money to do it. So it's creating a standby plan, getting it in place is something that I think is far preferable to waiting and seeing. And again, it gives you the time, and we're running out of time, but at least gives you some time to do deliberate planning. Jonathan, you want to talk about the Q-tip approach?
Yeah, one of the things you can do is, if your spouse is a U.S. citizen, is to create a Q-tippable trust for your spouse. Now, the beauty is that you have until you file your gift tax return for the year in which the trust was created to determine whether or not you want to have it qualify for the marital deduction by making the Q-tip election under section 2523, I think it's F, or not. And if you do this, say, right now, you would have to decide by October of 2000, you'd have to decide by October of 2026 when you want to do it, because your gift tax return for 2025, the year in which you created the Q-tip, is going to be due April 15, but with extensions October 15 of 2026. So you can decide up until then whether or not you want to do it. So that gives you a tremendous amount of time in order to determine whether or not you want to have it qualify for the marital deduction, in which case no tax is due. And in fact, the trustee could then give the assets to your spouse, and if your spouse was so inclined, could give them back to you. So this gives you a lot of time. Again, you could create that Q-tip trust or Q-tippable trust anytime you want this year, and yet have until the end of 2026, October 15 of 2026, to decide whether or not you want to have it qualify. And that gives you a tremendous amount of time to decide, do I want to use my exemption by not Q-tipping the trust, or do I want to not do it? So there's a lot of flexibility there. So if you're in a situation where you and your spouse see things eye to eye, and you're not worried about, and I worry about this from my wife, her running away with Marty, maybe you're in a position to really do something, get things set up. You get the trust almost perfectly the way you want it. And if they don't, if they do cut back on the exemption, you will go ahead and qualify it for marital deduction treatment or not. entirely up to you. So that's a great way if you're in a healthy marriage situation where it doesn't matter which spouse has it. But Marty, how about if, I do this for my wife, I create a Q-tippable trust for her, and she creates a Q-tippable trust for me, and we fund each with what we think are our exemptions. And maybe, again, we use a laundry clause. But does that work? She does one for me, and I do one for her?
It sounds like you're in the same identical position after the trusts were created as before. So that if under the reciprocal trust doctrine, the trusts are uncrossed, what have you done? But we're not, if it's a marital deduction, I'm not sure. Do you have an issue if it's a marital deduction?
Well, I think it complicates it very much.
How are you going to, you can't make the trust materially different if they're Q-tips. The requirements are too rigid.
Well, that's very true, Marty. So, what are you going to do? And can you, say, well, I'm going to Q-tip one, but not Q-tip the other? It's very tough to try to avoid the reciprocal trust doctrine. So you're deemed to have created this trust for yourself. Now, Dick Covey, one of the great estate planners who's ever lived, said, it doesn't matter. He said, you can go ahead and do it because you can get out of it. So the reciprocal trust doctrine shouldn't apply. He was a brilliant man, but I'm not exactly confident he was correct on that. I think it would be dangerous to try to create Q-tippable trust for the husband by the wife and for the wife by the husband and say, well, all I have to do is decide which one I want to Q-tip and which one I don't.
But for a lot of people, the beauty of the approach you described is I really would I mean, we have to know what's going to happen by October of next year. I mean, this can't go on for that long, can it? So by then, you know what to do and you'll be in a much better position. You've certainly given yourself the benefit of a lot of hindsight to make the appropriate decision on how you want your trust treated. Teresa,
Marty, one technical point, just for the lawyers listening. Many times the CPAs will be doing these gift tax returns. You cannot fix a late Q-tip, inter vivos Q-tip election.
Yeah,
So
great
Jonathan,
point.
if I miss the extension or I miss the final return, filing the return, you're going to end up with, you're not going to have the ability to make the Q-tip election. So for the lawyers, this has to be on your tickler system, and you need to make absolutely certain the CPAs doing those returns are on top of their game.
I
You got to
completely agree,
communicate the
Bob,
plan so
and
the
I
CPA
agree
knows
with
it.
you. Not everyone knows that you have to make that Q-tip election on time. If you wait until, the time to file the gift tax return expires originally, let's say turns out to be October 18 because there was a weekend or a holiday or something like that, you can't do it. You have to do it on time. You cannot get an extension of it at all. And I was involved with that, and I was not happy the way it came out. But you cannot have it qualify for the marital deduction unless you make the election, and the election has to be made on the timely filed gift tax return. If you're a day late, you can't do it, and you're stuck with no marital deduction at all.
It's important for the attorneys doing the planning to make sure the accountant understands what planning was done. You can't rely on the client going to the accountant and just handing them paperwork and the accountant figuring out what was done. So communication is really critical. Teresa, the next component or approach to flexibility is a disclaimer. And I know you can walk us through that and show us something that you can do in ILS. And by the way, for people that are still using their own documentation, this is a perfect example of the efficiency of document generation, and also the I'm trying to think of the word for it, Teresa, but it helps you draft better because you can't it's harder to overlook something when there's a dialog box that says, hey, do you want to do this? And Teresa is going to walk us through it. And literally, and forgive me, I don't want to belittle it, but for the user, not for the documentation, for the user, all you're doing is clicking a button. Teresa?
Right.
Oops.
Yeah, and this is an idea that I think the Q-tippable trust idea is better because you have a longer period of time, because we all probably know that if you're going to do a disclaimer, you have 9 months and you only have 9 months. It doesn't matter when your gift tax return can be extended. That's not going to help you here. So it's a 9-month deal, but the idea here is a way to unwind a gift to an irrevocable trust by saying that if the beneficiary disclaims the gift, it returns to the donor. And so you can do this in a couple of different ways. You can name a beneficiary as the primary beneficiary, if you will. And I think some people have concerns with that. You know, if I create a trust for all of my children, and I've got 3 of them, and I name my son because he's my favorite as the primary beneficiary, and he can disclaim on behalf of everybody, that sounds like that might not be a great idea. But there's some ideas here on this screen about, well, let's just create an initial trust that one person who has a disclaimer power, they're the only beneficiary. So they're only disclaiming on their own behalf. And then we can let the trust do different things down the road after we get past the disclaimer period. There's also the ability in some states to let a trustee disclaim, which sounds completely it would violate the trustee's fiduciary duty, right? To say, let's take trust property that I'm trustee of and give it back. But the state statutes say when that can happen. And so the image at the very bottom of the screen is just the options in our irrevocable trust, where you can say, yeah, I'd like this disclaimer option, or I'm in one of those states where it works to have the trustee do it. And then you don't have to worry about which beneficiary holds the power. So as Marty said, you can just check a box. Now, disclaimer is not the same as a rescission. That's on the next screen, and I'm going to hope somebody else talks more about that.
Before we go to rescission, think about this
Yeah.
also from not just the client's perspective. So clients, I think, will find this appealing because there's so much uncertainty, as we talked about in the beginning. And I'm not saying there's no risks or issues. According to some commentators, others disagree with this technique of a disclaimer. But on the outside chance, or on the chance that it works, why not give the clients that flexibility just to deal with the uncertainty that is frustrating them? And from the practitioner's perspective, the last thing we want to do as a practitioner is have a client unhappy and then blame us. You pushed me to do this plan. If I did push you to do the plan, I gave you a 9-month window to unravel the whole thing. So I think it's protective, I would think, of the practitioner as well, because the client can undo it if they choose to. If they don't undo it, then why is that the responsibility of the various planners that suggested the plan in the first place? So I think, there's some good benefits to that.
Marty, let me just add, though, that it is not the client who would make the decision whether
Correct.
or not to disclaim. It will be a beneficiary or a trustee. And as Teresa points out, maybe you cause a little problem if you have one beneficiary having the ability to disclaim, but I've done it that way. It's expressly in the instrument, and it doesn't say because I regard Sally or Sammy or Marty or whoever it is to be my favorite beneficiary. Maybe you have the eldest child. I will also say that I would not have a discussion with that person ahead of time. Hey, I'm going to come back to you and tell you to disclaim or not disclaim. Leave it up to them. But maybe it should really be up to the trustee. And the trustee is expressly authorized by the state statute to disclaim. And you can put in, and the statute says there's no liability for making the disclaimer. But I mean, that's a very, very potent power to have, is the ability to disclaim and unwind the whole thing. And keep in mind the following. If you do a qualified disclaimer, you don't even have to report it on any tax return. So as long as you haven't filed your return, the IRS theoretically will never know that you set up the trust and there was a disclaimer, and it all reverted back to the grantor, which should make the grantor very happy.
Jonathan, let me ask you a question. Since Teresa's now shown us that I can click a button and build in the disclaimer provision, given the incredible uncertainty that we described right now in the current environment, would it make sense as the default approach to any irrevocable trust to just throw it in so that you're giving clients a second look at it?
Marty, I think that is absolutely correct. Why not build in maximum flexibility?
Let me cover rescission really quick because we got much more important stuff to do. It's an income tax concept that may be applicable to gift planning, where if you can rescind the transaction and put the parties back to where they are at the outset before the transaction happened, and you do it during the same tax year, which means before the end of the year, you may be able, for income tax purposes, to unwind a transaction, and that may be applicable to estate and gift tax as well. Let's jump on to the next section. There have been bills now proposed to repeal the estate tax. These bills, as Jonathan explained earlier, have proposed retaining the gift tax, repealing the GST tax, and as Jonathan said, perhaps keeping the basis step up, which is kind of like having your ice cream with the cherry on top and whipped cream too, because you seem to get the best of all worlds. Do either of you want to talk about sort of the background to these and what it means? I know you've covered a bit already, Jonathan. Do you want to add to that?
Well, Marty, the only thing I can say is that, having no estate tax and having the tax-free step-up in basis obviously would be just the cat's meow for wealthy families. And maybe it will happen, but it really will be a remarkable change in the law that you can, retain things and you will retain them because, you want it back in your estate to get the tax-free step-up in basis. Now, one of the things, there may be pressure from children saying, hey, I still want to get something during my lifetime, but the parent says, no, I can't do that because I need these assets in my estate and there'll be no estate tax. I won't want to have to deal with gift tax and I get the tax-free step up in basis. Remember, a gift would be so much worse because not only do you face the possibility of a gift tax, whether it's 20% or 40%, it's going to be something significant, but you don't get the stepped up basis. So there's going to be a lot of pressure on parents to say no to their children. I'm sorry, I can't buy that apartment for you. I can't give you money for this. I can't do that because of it. Now, they'll presumably keep the exemptions large, for gift tax purposes, although one proposal said it would be a flat 10 million. But it would really change the way people deal in getting property over to their family. And indeed, that may be another reason to use the exemption today. At least you've used approximately 14 million of the exemption, even though at death it may be unlimited, but at least you can get something to your family now, although again, you'd be giving up that tax-free step-up in basis when you die. Although, as Mitch Gans and I have pointed out in an article, which is in the September 2023 issue of the Journal of Taxation, we believe there are ways, if you do it in trust, that you can get assets out of the estate and yet secure the tax-free step-up in basis under current law.
I would be really concerned. I'd be surprised if they're able to get that through no GST or estate tax, and a step up in basis, because the quid pro quo for the step up has always been the estate tax, which that quid pro quo kind of got out of kilter as the exemption amount went from 600 grand when long ago, I remember when Teresa said it was 600 when I was much of my practice, but in the beginning, and now 14 million. So that quid pro quo has kind of been emasculated. But if they eliminate the estate tax entirely and still leave a basis step up, it just seems like too good to be true for the very uber wealthy. And I just find it very hard to believe that that's going to get through Congress. And if it did, I cannot imagine that the Democrats wouldn't, as soon as possible, want to reverse that. And sometimes, when the pendulum swings too far one way, it unfortunately swings back far the other way. So that's why I think planning is going to be important, because I don't know that that's going to happen. I mean, it's been talked about, but we'll see. Do you think, Jonathan, there's any likelihood that they can permanently repeal the estate tax, given what the numbers might be in the Byrd rule?
Well, I don't know, Marty, because it would be the whole package. If the whole package results in a reduction in taxes, it's supposed to, unless they can get 60 senators to vote for it, and I doubt if they could, then it has to come back within 10 years. And it could come back sooner. I mean, if you have a change in 4 years, so you have, you know, a administration and a House and a Senate, they could put it all back in right away. I think it's almost impossible to forecast what will happen because it's largely a political decision. And I have found, at least in my experience, it's very hard to forecast political events.
So what kind of practical guidance can we give advisors? What do you do? What do you tell
Well, I
people?
think,
What do you tell
Marty,
clients?
I think you have people, as we started talking about at the beginning, I think you want to have people do trusts, and you can put them in so it's a standby trust, which Teresa addressed, or you build it in, it's irrevocable, but it can be changed either through a disclaimer or if you use a Q-tippable type trust by electing Q-tip so it qualifies for the marital deduction. Remember, your spouse has to be a US citizen, and yet you will able to get it back. I think that's critical to do. One of the things that I think people really need to focus on is getting their clients to do trust now. Now, again, you can do a trust that by its terms is irrevocable, but the grantor of that trust can retain sufficient powers over the trust that the transfer to the trust is incomplete for gift tax purposes. Keeping in mind that under one of the proposals that's been floated recently in the Congress is that if you transfer it to an irrevocable trust, you have no power to change it at all, it will still be considered an incomplete gift if it is a grantor trust for income tax purposes. And that's perhaps something that people will want to consider.
Wouldn't that
John,
change the, oh, go on, go on.
that's the Senate bill right now. I mean, I know you know this, but I just want to point out to everybody, that's a Senate bill right now. So I think this comes back to the point you and Marty have been making. This is every reason why we should be trying to fund these trusts now. Because we may not be able to do grantor trust and grantor trust sales after this happens. And we can get them in place now. It doesn't matter what Congress does in 4 years, 8 years, 12 years, 16 years. Hopefully they'd be grandfathered or protected in some way.
Bob, doesn't that also apply to GST?
Well, we'll get there, Marty, but right now, just let me go down the rabbit hole for a second and then we'll come back to it. I'll just 30 seconds. Right now we have grandfather trusts pre-September 85 and we have exempt trusts that we allocated to. If we have a repeal of the skipping transfer tax, we're going to have these post-repeal dynasty trusts, if you will. And it won't be until a future Congress brings back the generation skipping transfer tax that we know what we have. Just think about that. You're going to be putting money into the trust on blind faith that a Democratic Congress, 4 years, 8 years, 12 years, 16 years from now, will grandfather you much like Congress did under President Reagan in 1985. So that's the
benefit that
thing.
we had I was going to say in 2010, we knew that the GST tax was coming back. I remember that there was talk back then about making a transfer now while there is no GST tax, because we do know it's coming back. We knew the pendulum was going to swing. And like you say, Bob, you're going to be relying on it happening.
There was a lot of very solid planning done in 2010 because we had that window of opportunity.
Let me ask you a question. If I have a very large estate and I want to shift value out of the estate that's GST exempt, if I wait for estate tax repeal and do it then, I can't allocate GST exemption to the trust I create.
Correct.
Would it be advantageous for the very wealthy to make their gifts to GST exempt trusts, to even the wealthy, to GST exempt trusts today while we know we can allocate exemption, and maybe even do the note sale transaction to freeze value and shift a lot of value over the years to this GST exempt trust, even if repeal occurs, because at least if they grandfather something, maybe there's a chance that because it was done under the law when it worked, that the GST exempt planning done before repeal may be able to stay out of the tax system if the taxes are reinstated, whereas something done during that repeal period when you couldn't allocate GST exemption because there was no GST may not be protected. I don't know if that question made sense, but maybe one of you can explain it better and tell me your thoughts. I think it's probably worth the gamble to get it done now.
That's absolutely spot on, Marty. And there's two reasons for that. The first reason is the Senate bill would just crush the grantor trust. Okay, so that's just a textual reason. But the second reason is, again, if I fund something in August of 2025 after repeal, I don't know what I funded. I really
Right.
don't know what I have. And it won't be until a future Congress tells us what we have. And there's no way to predict that because a third of the people in a Congress 12 years from now are not in Congress right now. You know, so you have no reason to think that a committee is going to do the right thing or the wrong thing. You just don't know what they'll do.
Well, the margins, Bob, on votes on taxes is usually so close. I mean, right now you have a majority in the House and the Senate that are Republicans, but that could change, for example, in 2 years. I don't know that it'll happen, but it's possible that it will. And historically, the midterm election, that will be the election in 2018, it usually does result in whichever party won the election, in this case in 2016, would be eroded. And maybe, maybe it'll be even stronger. Maybe they'll get to 60 even, and they won't even have to worry about the Byrd rule. But if you think that history is kind of a guide to what will happen in the future, you better beware that you better get your business done, and it could all change or be stagnant in 2018, and then a complete change in 4 years after that, 2030.
So one of the things to talk to clients is plan now while you know you can allocate GST exemption. Shifting assets to long-term trusts may be the most prudent thing to do. I don't know how easy that is to sell to clients, and that's the wrong word, but to have clients understand that in the current environment. But and I don't want to belabor it because we talked about it earlier, but planning should always be, and should in the future always be holistic. We should be talking about saving income taxes, protecting wealth from lawsuits, divorce, and other claims, protecting heirs from their own irresponsibility. If you look at the statistical data on drug abuse, alcohol addiction, I mean, there's just a raft of addiction issues, special needs issues, all that require trusts. So it shouldn't only be about the estate tax, but we can try to address the issues with the estate tax, as we just said. Any comment on permanence? I think we've kind of really talked about that.
The one comment I wanted to make here is that the clients are going to think that if the estate tax is gone, I can just leave everything to my spouse and I don't need all this complexity. And one of the things that we built in to Interactive Legal was an option to say, well, you don't want to leave everything to your spouse if the estate tax is repealed outright. What you should do is, again, go back to what we've been saying, is put it in trust. And the reason for that is we expect the pendulum to swing back. And when the spouse later dies, if the estate tax is in effect again, you would want to avoid the estate tax and the GST tax, as we've been talking about it too. And so that's why we have an option where you, instead of leaving everything outright, or you could say I'm leaving everything outright, but we have a caveat. If there's no estate tax, instead it goes in trust for my spouse so that we avoid the estate tax in the future because we're expecting it to come back.
Now, we can't assure anybody that having it in that kind of trust will avoid the estate tax,
Exactly.
but it sure makes sense to try. What have you got to lose? Not to mention which, Teresa, why do we always do Q-tips now? Forget the tax. What's the real reason?
Second marriages.
Third marriages,
Creditor
fourth
protection,
marriages.
yeah. Mm-hmm.
We want
Exactly.
the money to be controlled. So trust remain the answer. These simple outright I love you wills rarely make any sense, and certainly not if there's any meaningful wealth. But I think we need to educate clients about that, because I think it's going to be harder for them to want to understand it.
Yeah, and so this is where I talk about, the client thinks it's going to be simple and we're going to make it a little bit more complex. And so on the next screen, I think you could probably just jump ahead to it to see the option where we say, if it's outright, we're going to have this alternate disposition if there's no estate tax, either to what we would think of as a traditional marital deduction trust. In other words, only the spouse is the beneficiary, all the income comes out, or a more flexible family trust. And I will tell you that when I first saw this option, which was at some point around 2010 perhaps, or before, because we had these leading up to 2010, I remember thinking, why would you use a marital trust? That's in the estate. And it may have been Jonathan who said, well, typically it would be, Teresa, but there's no estate tax, there's no Q-tip election, so there's nothing to trigger it in the spouse's estate. And so either one of these trusts technically would work. But as you said, we're kind of stumbling around in the dark here. We don't know if either trust would work to keep it out of the estate in the future, but it's the best bet.
And providing something for that may be required, as we're going to talk about what happens to formula clauses. So this is a great backstop to, if a formula clause doesn't work any longer when there's no estate tax, you've at least provided where the assets should go, so you have certainty to the plan. And that alone could be very, very important to do. And now that estate tax repeal is becoming, talked about to that degree, I think it's something that's very important. Jonathan, I'm going to let you talk for a couple minutes about how the impact on formulas and other documents, and I'll be right back.
Yeah, I mean, let me say that I wrote an article about 20 years ago on the danger of formula clauses, where you say, I'm going to give my kids the amount of the exemption, or I'm going to give my spouse everything minus the exemption. And the reason is that could have a dramatic effect on what people really receive. This could be, even in a first marriage, a tremendous, because if you say, well, I leave everything to my kids if there's no estate tax, then it would go into a family trust, but your surviving spouse will not be entitled to the same things. Now, you can build stuff in there to say, even if it all goes into this trust, I want my spouse to be considered the primary beneficiary of this trust, in which case you better have some independent people in there, because the kids may decide, well, their mother doesn't really need as much as she could get from the trust. So you've got to really think through the possibility that there won't be these formula provisions, but if there are formula provisions, to think that, when I began to practicing, the non-marital portion was $60,000. Now it's approximately 14 million. If you're whacking up the estate based on those things, holy mackerel, what a difference between what the spouse and what the children get. And so as a consequence, if you do not have an estate tax, maybe you want it to go entirely into one trust, but at least put in some strong suggestive language as to what the spouse is supposed to get as opposed to the kids. Most people who are in a first marriage situation, I realize there are exceptions, will want their spouse to be considered the primary beneficiary of their wealth until he or she dies. And then it can be primarily for the descendants. This is even more stark where you have someone who's wanting to have the non-marital portion go to charity. And in fact, it's just crazy about how much charity would or would not get, just depending upon when they die and whether or not there's an estate tax in effect. I had one gentleman who I didn't do his final will, but I was aware of the fact that he basically said that I want everything that can pass tax-free to go to my brothers and sisters and my nieces and nephews, but the balance to go to charity. Well, he died in 2010. The entire amount could go to them if you elected into the system. And that made it very, very difficult. It was finally a compromise with the collaboration of the Attorney General for that state, because remember, charity is represented in every state by its Attorney General. So again, using these formula clauses where it's really going to change what people get can be extremely difficult to handle. So if you decide you're going to use a formula, you better think about, well, what if the estate tax is repealed? What if the estate tax exemption isn't 14 million, it goes back to 4, or it goes up to 40? And think about what those differences could be, even in a first marriage situation.
I think the challenge is that a lot of planning documents use formulas because that's how you build in flexibility to adjust, because we don't know what the tax is and we are trying to avoid tax. So relying on formulas is commonplace. But the problem is, if something so radical is not just a change in the exemption, but a change in the repeal, by the repeal of the estate tax occurs, the formulas may be non-functional and the entire plan could be tipped on its head. So I think one of the most important things for advisors I would start alerting clients now. When financial advisors have like a quarterly meeting or something with the client, they should say, hey, just so you know, there's talk of an estate tax repeal. We can't predict what'll happen, but if it does, you got to get back to your estate plan, or all your documentation may have to be revised, or you could face a disaster. We need to educate clients. So many clients, and I remember reading something, I think it was in Kitses, if I'm pronouncing his last name correctly, the financial advisor's advisor, that like the average will is over 20 years old. In other words, clients don't revise their wills more frequently than every 20 years on average. And we've all seen as practitioners where kids call you, mom passed away, I'm so sorry to hear. And you look up in your file and she did a will like 28 years ago. I mean, why would they not think to come back? The state may have changed its estate tax. The exemption went from 600 to 14 million. I mean, the world has changed how many times over, and they don't come back to update something. So educating everybody as to the impact, huge potential impact, not on all, but on many estate plans is really important. Bob, do you want to talk about some of these examples quick, or would you prefer I do it?
I'll take it. So here's the math.
Ooh, sorry.
So here's the math, Marty. To my loving wife, that dollar amount which results in no federal estate tax. So pecuniary funding clause. If somebody died today, 13,990,000 would go into a bypass trust, 10 million would go to the spouse. Pretty easy. But after enactment, spouse would actually receive 0. Just like Jonathan was alluded to with the 2010 death. And same thing if you had charity. What if you wanted to leave 40% of your estate to charity? You thought you just worded that the exemption amount to my bypass trust, everything above the exemption amount to charity, suddenly the charity would also go to 0. So it's a really problematic thing. And I think lawyers are going to have to kind of really rack their brain as to who has these formulas where it's like in a second marriage, this could be really painful, or for anybody that's leaving, has a charitable cap on their estate plan, they really have to go back and revise that.
Well, let me point out, it says to the Children's Hospital, that dollar amount that results in no federal estate tax. Well, isn't that the whole estate? Because if it all goes to the Children's Hospital, there's going to be no taxable estate, whether there's an estate tax and regardless of the exemption. So using language like that, I would find very, very confusing. Yes. I don't think that was intended, but it says that dollar amount results in no federal estate tax. Well, that's the whole estate, whether it's 5 million, whether it's 500 million. If you have it all go to charity, there will be no tax and the kids wouldn't get anything. And by the way, during 2010, when people died, there were some cases that came out. What did they mean? And one of the things that I like to do in my documents is to give the court an indication to basically tell them what I intend to, I intend for my spouse to get the maximum that the spouse can get free of tax, or I intend my kids to get the maximum, which results in no tax. But if you say to my kids that results in no tax, if there's no estate tax, they're getting everything. and the spouse is getting nothing. And considering that, you know, about half of all marriages wind up in divorce, you've got to be extremely careful. And, you know, Marty, as you said, most wills are not revised for years and years. And even though whenever people get divorced, they ought to redo their estate planning documents, in the majority of cases, they don't do it. Now, almost every state now has a rule that if you have a bequest to or for your spouse and you're divorced, that bequest doesn't take effect. But if you've used something like a will substitute, like a revocable trust, and you go ahead and have word formulas in there, that thing that says, well, if you've been divorced, nothing will go to your spouse, that won't apply because it's not under a will, where they put in that if you've named your spouse to get something in your will, it won't count if you've been divorced, but it's not under your will, it's under a revocable trust, or maybe an irrevocable trust, which is not a completed gift. So you really got to think these things through very, very carefully.
I think the bottom line is, I know some firms I've heard, I don't know how they do it, try to track what's in various documents in a database. The issue I have with that is I don't know very many firms that do that, and I don't even know how you track it, because is the repeal of the estate tax and the impact on a formula clause one of the things that you tracked, or did you just track that they had a credit shelter trust that was funded with a dollar amount? I don't know. I think the bottom line is there's no way to know which clients are affected, that all of us and all the allied professions, if repeal should happen, need to start telling people now, bear in mind, if repeal happens, you got to get your documents reviewed. It may not only not work the way you want, it could be an unfettered disaster. I think we have to get clients to look at it on an individual basis. Whether or not the various software programs that review and summarize documents, the EIA programs, are going to pick up on this or not, I wouldn't be confident. This is pretty nuanced. I don't think we're there yet. They may catch some things, but I wouldn't rely on that. I'd rely on a lawyer's eyeball looking at a document and a current balance sheet and telling the client what happens. So this is going to be a hard sell because, oh, it's a repeal. I don't have to worry about estate taxes. Why would I spend money on a lawyer? A lot of people will really need to do so.
Well,
Bob, do you want to do?
Marty, also keep in mind that there are about a dozen states that have a state death tax, and it may well be that if the federal government gets out of the estate tax business, that the states will come back. Remember, before in 1916, it was the states that imposed the death tax. It wasn't the it wasn't the federal government. So you got to keep that in mind. And it may depend upon the formula you use and the state you die in, or whether or not you have property in a state that has a state tax.
I think if it's okay with you guys, there's another case study that talks about some of this, but maybe we can just go over it more quickly and just state some of the concepts. And the point is really to just emphasize how the actual results can vary across the board depending on what happens with repeal or other changes to the estate tax. So, you know, if an estate is, call it 30 million, and it's all highly appreciated stock, to keep the facts real simple, in 2025, the husband could bequeath 14 million to a dynasty trust for children from a prior marriage, and he could provide that amount and bequeath the remaining 16 million, rounding, to a trust for his wife to avoid any current or defer any current tax. And that may have worked fine. If there's no change in the current law and the Republicans aren't successful in extending the exemption's reduced by half to say 7 million. So with no change to the husband's documents, the children now will get 7 million. Previously, before, under current law, if the you know, it would be 14 million to the kids. If the exemption goes down, the kids will get half of that, 7 million. That seems completely arbitrary and not something that any client would possibly have wanted. That, gee, because the law didn't change or did change, the amount going to my kids is cut by half. But that's the arbitrariness of the impact of a change in the exemption and the formulas that are commonly used. And we need to be alert to that. If the bonus exemption is extended, now we're back to the kids getting 14 million. This doesn't make any sense because it can't be that somebody would have wanted such a wild fluctuation in what the kids from a prior marriage got just because of an arbitrary tax change. So if Congress can act to get the exemption extended, the kids get half of what they would if they do make the exemption either permanent or extended for 10 years. But if they only extend it for 10 years, you have the same flip-flop that when that 10 years ends, unless the next Congress is also Republican and does the same thing, it's not going to happen. It's a coin toss, not good. If they repeal the estate tax and leave a basis step up, a different mechanism would have to be created to report the basis step up, since there's not going to be an estate tax return. We don't know what that would be. And as I said earlier, the quid pro quo historically has been that you pay an estate tax and you get a basis step up. Now that's gone. And if the estate tax is repealed with the formula, the kids may get the entire 30 million with no tax cost, and the second wife or second spouse will get perhaps nothing. If they leave intact the $15 million, the basis step up without an estate tax, the 15 million gets a free basis step up, and the kids ignore and don't have to be subjected to a capital gain. But it really could result in his children getting all the money, no estate tax, no capital gains, but it may not work the way they want. If there was a formula giving an amount to the trust for his children tied to the maximum that can pass free of estate tax and the balance to the marital, what do the children get? Well, anything can pass free of estate tax. Is the bequest to the children infinite or zero? This is the same ambiguity that Jonathan pointed out earlier. So here's a quick summary, which I'm going to skip through. So I think the question or the key point, and I haven't really heard anyone talk about it, but it's really huge. If the estate tax is repealed, and frankly, it's not even just that, if the exemption is extended or not extended, people could get whipsawed and their plan absolutely not carried out the way they anticipated when they did the documents. So really, documents need to be looked at. This is something that financial advisors and accountants need to help address, because clients are going to make the incorrect assumption, gee, the exemption is now permanent, I don't have to go back, or the exemption went down, there's nothing I can do. But what did it do to their plan? Very, very important to educate clients to address this. One of the easiest answers is to update plans. But there's also a gamble. What if somebody's old and not well now? Do they leave this alone because right now there's no requirement for a change? Or perhaps if somebody is older or infirm, they should update their documents now and do what Jonathan said. Add some direction. I'm leaving this formula to my kids because my anticipation is my kids will get 14 million and my current wife 16 million, and that's really what I intend. Put some direction in there, so if it has to be interpreted by a court, if the laws change, don't change, or repeal, you have some guidance. Most documents don't have that. Most documents a lot of documents are just pure formula based. So you could also address, and Teresa pointed this out before, and I think she has some more examples, that if repeal occurs, here's where I want stuff to go. And just specifying whether it's a credit shelter family type trust, who should be the primary beneficiary, or a marital type trust, if there's repeal, could save the day. Teresa?
Yes, and so this is an option for what if there is no federal estate tax, and we're already doing, say, a two-share plan where we were going to have a formula gift to a credit shelter trust of the federal exemption. And so if that doesn't work because there is no federal estate tax, we have alternate provisions that come in. And the one on the screen here is, if there's no federal estate tax, you can choose that all property goes to the credit shelter type trust. We don't need to shelter a credit anymore, but it's that type of trust, or all property goes to the Q-tip trust. And I think the choice there is really, do you want the spouse to get all the income and be the only beneficiary? Because we're really in the same place we were with the other option. We're assuming that these trusts are both not going to be subject to estate tax if it comes back. But this way we don't have to worry that we have an unintended result because the formulas didn't work the way we expected. We are just mandating that everything go to one or the other of these trusts. Now, you also could mandate that something different happens. These are just the options that we have. And then we also have an option to do the same thing for somebody who's unmarried with the GST exemption amount. You would typically carve off your GST exemption amount and put that in a dynasty trust. And then the rest could go into a trust that might also last for a lifetime, but it could go outright or terminate at an age. But if someone chooses the option to include a provision for GST repeal, then everything goes into the dynasty trust, because we're going to assume that it's going to escape transfer taxation for generations to come, and it will be grandfathered. Again, we're making that assumption. We don't know what the repeal would look like until we actually see what language passes. And then we have something similar for decoupled states, but I think that's coming up a little bit later.
Let me make a comment similar to one I made earlier. I had suggested when Jonathan was talking about, or Teresa was talking about, the disclaimer provision, that maybe the default approach with the incredible uncertainty we have now is to build a disclaimer provision, leaving aside whether you think it works, doesn't work, et cetera, but building it in to as a default to any irrevocable trust unless the client says, I don't want it, because it gives the chance to unwind the planning if everything goes topsy-turvy with the changes to the law. I don't think very many practitioners in the last few years have been building in anything about the repeal of the estate tax. I think many of us thought that we'd have a very different political environment now and a very different estate tax status. But it seems now with the talk of repeal, whether it happens or not, we can't predict. Just like I said with the disclaimer, why not build something in just in case the estate tax is repealed? So if by default, and you saw how you could whipsaw between kids from a prior marriage and current spouse, if everything defaulted to a family trust and you specified that the kids or the spouse would be primary beneficiary, or intentionally you specify that all are primary and there's no favoritism to be showed, even if the formulas don't adjust, it's all in one pot trust, and an independent trustee can at least use discretion to try to keep everybody happy and maintain the peace, rather than it whipsaw and all end up one way or the other way and leave somebody in the lurch, which probably will end up in a bad situation.
I will say that over time, we've had people question, what are these provisions here for? We're confused. There is no estate tax repeal. And of course, they were correct. And most of the time when somebody had this in a document they were drafting, it was by accident. But there have been a handful of people over the years where they were intentionally putting in provisions for if the estate tax is ever repealed. And I think they probably recognize that their clients might not come back and revise their documents, and this way they at least had covered to a certain extent what would happen in that case.
Yeah, I think that's pretty rare. I don't think very many people have done that, but maybe
Maybe.
while clients want things simple, maybe you got to do more. And again, I don't get a commission. You can confirm that, Teresa. But the
No.
advantage of document generation, you don't have to go back and revise your forms. You click a button. And if this is not foremost on your mind when you're going through the template, you're going to see the question. So just answer it, and you have something there.
Well, and whatever form the repeal takes, we're going to have to figure it out to update our documents to make sure our documents work with what the final law is. We remember that in 2010, there were some qualified spousal transfers that could still get the step up in basis. And so we had to have provisions for that. So we don't know what provisions will be in the final law, but the benefit of an automated system, any automated system, should be that the practitioner doesn't have to worry about updating the forms, because somebody's going to do that for
Constantly.
them. Yep.
Bob, you brought up, and I hadn't thought of it until you actually said it, portability. You want to explain the possible whipsaw portability?
The statutory language that we have right now takes away all of the estate tax provisions, including portability. So if somebody died on the other side of repeal, their family, their spouse would not be able to file a return to obtain portability. So assume H dies in 2027 when there's no tax. With an estate of 15 million, he leaves it to W, her estate is 30. In 2023, Congress reinstates the estate tax. If W died in 2032, we're golden. But if she dies in 2037, we have a problem. The estate tax on $30 million minus her exemption is basically going to be a very large number. There's no exemption to be transferred from H. Now, if he had died when portability was available, she probably wouldn't have an estate tax at her death. So this is big. And I think the moral of the story is if you die after repeal, you need to push that property into a trust for your spouse, your children, your grandchildren, etc. Because then it wouldn't be included in your spouse's estate. So this is a huge issue. It becomes very complicated when there's a state estate tax. That's going to make it more complicated, but this is the issue, Marty.
Bob, doesn't that also kind of suggest what we said earlier, that even though a lot of clients are going to be loath to plan now because, gee, maybe they'll repeal it, you may be better off, given the pendulum swings that we've seen over history with in Congress with the tax system, to get your planning done before all this occurs.
I think there's merit to that. I mean, certainly if you're representing a surviving spouse who has her exemption plus her husband's to sue, you have to figure out, what are you going to do? You know, are you going to give that away?
So one of the common themes, and we've talked about this, so I'll just go through some of it quickly, unless somebody else has a comment on the panel, is you want as much flexibility as possible because, my gosh, look at all the unknowns. You want to build in disclaimer provisions in revocable trust. You want to build in provisions in wills and trusts for possible repeal. You want to consider using powers of appointment that may be able to help recast a trust. You may want to use trust protectors. You want to set up trusts in states that are more likely to respond quickly and flexibly to law changes. Use swap powers. Think of the grantor trust that Jonathan talked about. You may want to have the ability to get those assets back in the estate to make sure that you get a step up. And what about irrevocable trusts now that are out of the estate tax system? But if the estate tax is repealed and there's a basis step up, maybe you want to be prepared to swap those assets back in. Broad authority to hold personal use assets, loans, decanting powers, mechanisms like disclaimers or others to unwind the plan or the Q-tippable trust, maybe giving a power to cause estate inclusion. We've already discussed that gift tax will remain and how that may affect planning. We don't know. Jonathan, did you want to comment at all further? Because you did discuss it earlier about grantor trusts. I was also thinking from an asset protection perspective, if a grantor trust doesn't trigger a gift tax, and we're not worried about an estate tax, from an asset protection perspective, you've kind of taken the lid off planning. Why not put everything in an irrevocable grantor trust and protect it from creditors?
Well, I think that makes some sense, Marty. There will people who won't do it because they want to have tremendous amounts of control. But, you know, if you have an asset protection trust, you can retain a lot of control. You can certainly retain, in most states that have asset protection legislation, you can retain a special power of appointment so you can determine who gets it at the time that you die. And that could be a new girlfriend or boyfriend or a new spouse or whatever. But, you know, if they really do this, it's going to really change the game in estate planning.
We've talked about GST, so I think we can skip through that. We've already suggested that getting assets into a dynastic trust and allocating GST before we have repeal so we know what we're dealing with we can't guarantee it, but may prove better. Bob or Teresa, did either of you want to comment on state estate tax? Jonathan?
I can make a brief comment on that. It's the issue that even if we get rid of the federal estate tax, you're going to have states that still have state estate tax. So we still want a bypass trust at the very least to set aside or to shelter the state estate tax exemption. And so we might have built a plan that's going to take advantage of both state and federal, and now federal is off the table. And so some states are going to have a state estate tax that is patterned after the federal, and in those states, the state estate tax may also not exist. If it's really patterned after the federal, they may have to make legislative changes. But there are other states, and I think Massachusetts is one that comes to mind, where their state estate tax is really its kind of own system, and it's tied to the federal, but it's got its own statutory scheme, and so it's still going to be in place even if the federal goes away. It also, will depend on what these state legislatures do. They may find it, a great way to raise revenue, or it might be something that is too burdensome to maintain without having a federal estate tax return to rely on. The way we approach it for these decoupled states is on the next slide, where again, we have an option for what if there is no federal estate tax. And this is one that I would pick if I was in that decoupled state, where I still want to create my credit shelter trust, but I want to remove the federal estate tax exemption from the equation. So we're going to base our marital deduction and our non-marital gift on the state exemption amount only. And then we give an option for how your marital deduction gift will work, because some states don't have a state-only Q-tip. You get a marital deduction in the state if the federal Q-tip election is made, and if that doesn't exist, you can't get the state-only Q-tip. So other types of marital deduction gifts are permitted. And so that's just a way to add in flexibility in decoupled states.
I hadn't thought about that till you said it just now, but what a mess. The federal estate tax is repealed. You're in a decoupled state. You want to get a Q-tip and it doesn't work.
Right.
Use a general clients are going to think it's going to be much simpler, but boy, this is anything but simple. QDOTs are going to stick around for 10 years and still have some tax, even if they repeal it. I'm not sure why. Jonathan, you want to make some concluding comments and we can wrap up? And Bob, you can follow, and Teresa after that.
No, Marty, I think we have beaten it enough. I really do.
Bob, any final words of wisdom?
I think the big thing is to keep an eye on this. We'll all be writing and posting about this, and be ready to move like lightning. If we get this passes in the House and is on its way to the Senate and eventually on its way to the President, this bill is effective date of enactment. That means if there's 2 weeks between the House, from the House passing to President Trump signing, we'll have 2 weeks to do some things for clients. So keep an eye on these dates, and just keep an eye on what this eventual legislation looks like.
Teresa, any final words?
No, I really think that was a good final word. Keep an eye on it.
So let me, because I have to, I'm sorry. Let me add one last point and then we'll wrap up. We have an article, the group of us, on repeal and extension of bonus exemption versus not, and all the things that we've been talking about. That article, whenever we get it published, we'll post it to the ILS will post it to its website. Peak Trust Company, Jonathan, I assume, will post it to its website, and I'll post it to my website, and I assume Bob will do the same and maybe disseminate it in other ways. I think it's really important to communicate to clients, because think about what Bob just said. We may have a really narrow window to act and it may be almost impossible. I'd rather have been upfront telling clients, hey, this stuff is coming. You should really come and talk. Not that anyone has. But for example, we include an article every month when we send a bill out. And this month, February's article is going to be on the potential for repeal. And we're going to have a much longer article available. When you access that article, steal some of what we said and rewrite it for your clients and use it to communicate. I think communication is really important, because some clients, if they really get what could happen, it may be worth their spending a little bit of money to update their documents for some of these possibilities, just given the dramatic changes that this could have on their dispositive plan. So I guess that's my final comment. Thank you for joining us, and thank you for hopefully having stuck with us for the whole time. Thank you, Jonathan. Thank you, Teresa. Thank you, Bob, and thank you, Peak and ILS.
Thanks for having us.
Thank you, everyone.
Bye.
Bye.